You turn 60. You have heard it your whole working life. Once you hit 60, your super comes out completely tax-free, no matter what. So you go to withdraw some, expecting exactly that. For most people, that is true, but there are 4 real specific situations where it is not. And if you fall into one of them without knowing, you can end up with a tax bill you never saw coming. Let's go through exactly who this applies to, and who the exceptions actually catch. First, the good news, because it is genuinely true for the majority of Australians. If your super sits in what's called a taxed fund, which covers almost every industry fund and retail fund in the country, then once you turn 60, withdrawals, whether as a lump sum or an income stream, really are completely free of tax. No further deductions, no separate tax return line, nothing. For most people watching this, that blanket statement holds up exactly as advertised. It's worth knowing why 60 specifically is the line, because it makes the exceptions easier to understand too. Before 60, withdrawals from a taxed fund can still attract tax on certain components, depending on your age and the type of payment. 60 is simply the point where the government decided most people have genuinely reached retirement, and from that age, the tax office stops taxing withdrawals from a standard taxed fund altogether. That's a deliberate, generous concession, which is exactly why it gets repeated as a blanket rule so often, and exactly why the handful of situations sitting outside that concession get so little attention by comparison. But here's what almost none of those blanket statements ever mention. That rule is specifically about taxed funds, and there are people it simply doesn't cover. The first exception is untaxed funds, a smaller category, but a real one, mostly covering certain government employee schemes, like SSS in South Australia or West State Super in Western Australia. These funds didn't pay tax on contributions or earnings the way a normal fund did along the way, so the tax gets collected at the other end instead. If you're in one of these schemes, the untaxed portion of your benefit is taxed at a higher rate even after 60, not the blanket 0 everyone assumes. If you've ever worked in the public service, particularly in South Australia or WA, this is worth checking specifically, because you may not even know which category your fund falls into. To put a number on it, someone drawing $60,000 a year from an ordinary taxed fund at 65 pays nothing extra at all. Someone drawing that same $60,000 from an untaxed element of a scheme like SSS can have a real portion of it taxed at a rate that would surprise them, purely because of which fund their employer used decades ago, a detail almost nobody thinks to check until the tax bill arrives. The second exception is capped defined benefit income streams, the kind of fixed employer-style pension some older public sector and corporate schemes still pay. There's a defined benefit income cap sitting at around $131,250 for this financial year, and any income above that cap from one of these schemes gets taxed, even though you're well past 60. So if you're on a genuinely generous defined benefit pension, the tax-free assumption can quietly stop applying to the top slice of it, and that's a very different situation from someone drawing an ordinary account-based pension from a standard fund. Say your defined benefit pension pays you $150,000 a year, comfortably above that roughly $131,250 cap. The portion under the cap stays tax-free as expected. The roughly $19,000 sitting above it gets added to your taxable income for the year, the same as ordinary wages would be. Most people on standard super balances will never come close to this cap, but if your old employer's scheme was genuinely generous, it's worth checking exactly where your pension sits against it. The third exception catches people who aren't even the original owner of the super, inheriting someone else's. If you receive a death benefit from a taxed fund and you're not a dependent under the tax rules, that payment can be taxed at up to 15%, plus the Medicare levy, regardless of your own age. Picture an adult child, well into their 50s, inheriting a parent's super balance. They didn't do anything wrong, and neither did their parent, but because they're generally not a tax dependent, a real chunk of that inheritance can be taxed on the way through, in a situation most families assume is simply a tax-free gift. On a $200,000 inheritance, that 15% tax plus the Medicare levy can work out to somewhere in the order of $34,000. Money the family often only discovers is owed after the payment has already been processed, not before, because nobody flagged it as a taxable event in the first place. And the fourth exception is the transfer balance cap. Currently $2.1 million per person from the middle of this year. This caps how much you can move into a tax-free retirement income stream in the first place. If your balance is large enough to exceed that cap, the excess has to be moved back into accumulation phase or taken out, and the earnings on that excess get taxed, 15% the first time it happens, rising to 30% if it happens again. This one only affects people with genuinely substantial balances, but for those it does affect, it's a real ongoing tax exposure sitting quietly inside a system most people assume is entirely tax-free once they're past 60. As an example, someone who moves $2.3 million into a retirement income stream this year is $200,000 over the cap. That excess has to come back out of the tax-free retirement phase, and any earnings it made while it was in there get taxed at 15% the first time around. It's not a penalty on the whole balance, just the slice that genuinely exceeded the personal cap. But it's a real ongoing rule for anyone with a balance at that level, not a one-off oversight that gets forgiven. So, who does this actually affect? If you spent your career in an ordinary industry or retail super fund and your balance is comfortably under the cap, the original blanket statement is completely accurate for you. Your withdrawals really are tax-free. The exceptions specifically catch four narrower groups: people in older, untaxed public sector schemes, people on generous cap-defined benefit pensions, people inheriting super from someone who wasn't their dependent, and people with balances large enough to exceed the transfer balance cap. If none of those describe you, you can relax. If one of them does, it's worth getting your own fund status and your own balance checked properly, because the difference between completely tax-free and mostly tax-free can be a genuinely significant amount of money. Checking which category you fall into is simpler than it sounds. Your annual super statement, or your fund's member portal, will tell you whether you're in a taxed or untaxed scheme. It's usually stated plainly, just rarely read. Your MyGov account, linked to the ATO, shows your total super balance against the transfer balance cap, if you're already drawing an income stream. And if you're not sure whether an inheritance you've received counts as a dependent payment, that's a specific, quick question for the fund itself, or a registered tax agent, rather than something to assume either way. Two honest notes. First, the specific caps and thresholds mentioned here are indexed and change, so confirm the current figures with the ATO before relying on them. Second, this is general information, not personal tax advice. Your fund type, your balance, and your own situation determine which of these actually applies to you. So this is exactly the kind of thing to confirm with the ATO directly, or a registered tax agent, or licensed financial advisor, before you assume either way. If you found out you're in one of these four categories, tell me in the comments. It helps me know what to cover next. Take care, and I'll see you in the next one.